Ever get that feeling? Like you're placing a trade, all confident, and bam, the price isn't what you expected.
Yeah. Happens to the best of us. That, my
Right.
friend, is slippage rearing its, well, slippery head.
And today, we're tackling it head on. What causes it, how to minimize it, and why it might not always be the broker's fault. Even though sometimes it feels that way, am I right?
You're singing my song. This deep dive will equip everyone out there with the knowledge they need to really, truly grasp slippage. And to navigate it effectively, too, of course.
Exactly. So let's set the stage here. We're diving deep into slippage with, you guessed it, understanding slippage as our trusty guide. But like always, we'll bring our own insights and experiences to the table too. Sound good?
Music to my ears. Let's do it.
Perfect. So slippage. The word itself just sounds, well, slippery, like something you don't want to get caught up in.
It does, doesn't it? And for traders, especially those new to the game, it can feel like this mysterious force that's working against them. But really, it's just a natural part of the market, like gravity or something.
Okay, so let's break it down. No jargon, just straight talk. What is slippage, really?
In the simplest terms, slippage is what happens when there's a difference between the price you see when you click buy or sell and the price your order is actually executed at.
So it's like going to buy that coffee you've been eyeing all morning, only to find the price went up by the time you reached the counter.
Perfect analogy. Though, keep in mind, just like with coffee, sometimes the price can go down too. You get to the counter and, surprise, it's happy hour. That's positive slippage. You get a better price than you expected.
So it's not always a bad thing. Got it. But our source, Understanding Slippage, points out that there are several reasons why this happens. What are some of the key culprits we should be aware of?
Well, like you mentioned earlier, sometimes it feels like it's the broker, but most of the time it boils down to two major factors: volatility and liquidity.
Okay, so let's take those one at a time. Let's start with volatility, because that feels like a big one, especially these days. What exactly does volatility mean in the context of trading?
Think of this volatility is basically how much the price of an asset, like a stock or a cryptocurrency, jumps around. The more volatile the market, the more likely it is that the price will change in the blink of an eye between the time you click the mouse and the time your order actually goes through.
So like trying to catch a fly with chopsticks, fast and unpredictable.
Exactly. And the faster and more unpredictable the price movements are, the harder it is to get your order filled at that exact price you saw just a second ago.
Makes sense. Now, what about liquidity? How does that play into this whole slippage game?
Liquidity is essentially how easy it is to buy or sell an asset at a given time. Imagine you're trying to sell that rare vintage comic book, but there's only a handful of collectors out there who are even interested. Chances are it's going to take some time to find a buyer willing to pay what you think it's worth, right?
Yeah, you might have to haggle a bit, maybe even lower your asking price.
Exactly. Now, in the trading world, low liquidity means there aren't a lot of buy or sell orders available at your desired price, so your order might have to wait in line, so to speak, which can lead to, you guessed it, slippage.
Okay, so low liquidity equals a higher chance of slippage.
Got it. So how do we use all this knowledge to actually avoid getting caught in these slippery situations?
Well, first off, remember what we said about market orders versus limit orders.
Remind us.
Right. So with a market order, you're basically saying, get me this stock at whatever the going price is right now. Speed is the name of the game. Which could be great if the market's stable, but
if the market's moving like a roller coaster, you might end up clinging on for dear life as the price swings wildly away from your intended entry point. Ouch.
ouch is right. With a limit order, you set your price. You're basically saying, this is the price I'm willing to pay, no more, no less. It's like setting down a line in the sand.
So, more control, but maybe a bit slower execution. It's that trade-off between speed and price certainty again. Exactly. And, I think a lot of traders, especially those just starting out, get spooked by slippage and start pointing fingers at the broker.
Oh yeah, my broker is cheating me. It's a common sentiment for sure, but our source, Understanding Slippage, sets the record straight on that one.
They do. Look, Monaxa, like any other brokerage, they're obligated to get their clients the best possible price. That's just good business. But it's important to remember that they're not puppet masters controlling the market. They're operating within it, just like the rest of us.
It's like being in a race car.
Mhm.
Your broker gives you a super fast car and all the training, but they can't control the weather conditions or the other drivers on the track.
Love the analogy. So you've got to take responsibility for your own actions out there on the track. Speaking of which, what are some of your go-to strategies for minimizing slippage?
Well, Aside from using limit orders whenever possible,
Yeah.
like you mentioned, I always check the economic calendar before making any big moves.
Yeah.
Monaxa makes this super easy, by the way. They have a really comprehensive one right on their website.
I'm always telling people it's like checking the weather forecast before you head out for the day.
Exactly. You don't want to be caught in a downpour without an umbrella, and you certainly don't want to be placing trades during a major news event without expecting a little slippage.
Speaking of Monaxa, I was really impressed with the section in Understanding Slippage that talks about their specific policies on this whole issue. Transparency is key in this business, and they seem to really get that.
Yeah, they do. They talk about how they use something called dynamic slippage tolerance. What's that all about?
So instead of having a fixed percentage for slippage tolerance, which is what some brokers do, they adjust it in real time based on market conditions.
So it's more responsive to what's actually happening in the market at any given moment. Smart.
Precisely. And importantly, they're very clear about the fact that they don't engage in asymmetric slippage.
So no shady business of profiting more from negative slippage than they pass on as positive slippage. Everything's above board.
Exactly. Now, before we wrap up, I want to leave our listeners with a little food for thought. We've talked about the importance of understanding the trade-off between speed and price certainty, but how do you weigh those factors differently depending on your trading strategy? What's more important to you in different market conditions?
Fantastic question to end on. And remember, folks, knowledge is power. The more you understand about slippage, the better equipped you'll be to navigate the markets with confidence and make smart trading decisions.
I'm going to say it better myself.
Until next time, trade smart and stay slippery, my friends. Just kidding. Let's avoid the slip-ups.